Hello, everybody, and welcome to my very first Watchlist Wednesdays stock review, where I go a little bit more in depth in a stock that I may or may not add to my portfolio in the near future. Our first stock is RTX Technologies, formerly known as Raytheon Technologies. Its ticker symbol is RTX, and it's an industrial in the aerospace and defense industry. Currently, its market cap is $110.07 billion. RTX is a highly diverse company. They're in many different segments of the US and NATO defense industries. They have solutions for land, sea, air, space, cyber, strategic missiles, integrated air defenses, and advanced technologies. That is basically their miscellaneous catch all term for everything else. They're highly diversified and they are used in almost every single platform in some way, shape, or form. The reason I'm looking into this company at this time is because it's had a string of headlines coming out that have caused the stock to drop dramatically in the last week or two. The first of these is that RTX plans to take a $3 billion charge as it recalls and inspects more than 600 engines made out of its Pratt & Whitney segment. These engines were primarily used in the A320neo jets bought by Airbus, and the company RTX does not expect the maintenance and repairs for these to be completed until 2026. This might not be the end of their woes. The issue is related to metal that was used in the engines. So we could find that metal has been used in other pieces of equipment that'll need to be repaired by RTX as well. This is an evolving story, but hopefully for the company, it stays at a $3 billion charge because it could get exponentially larger if they find that this metal was defective in other products as well. The second negative headline is that a deal with RTX in the Kingdom of Saudi Arabia has been called off. This deal was worth an approximate $25 billion, and it was canceled due to worries that the Saudis might also be working in conjunction with sanctioned Russian and Chinese firms. This means that a very large deal that was an expected revenue stream for the company will no longer be coming, and it also gives worries for deals down the line that certain countries or certain companies cannot make deals with these aerospace companies because the technology that is owned by the aerospace company, and RTX in this case, is too sensitive to be shared. And so that might limit their customer pool beyond just this single deal. So now that we've covered the major headwinds facing the company, let's go look at the balance sheet. Let's look at some numbers and let's see if this is a good deal or not. Up first is revenue, which has grown at nearly 20% per year over the last 5 years. This is a beautiful up and to the right chart. I see nothing wrong with this. Growth is starting to moderate, but a lot of this growth came off of the acquisition of, I believe it was United Technologies. The ticker symbol was UTX, which really helped grow the overall revenues for the company. That acquisition occurred in 2020. Annual gross profit is also showing a wonderful trend up and to the right, growing at almost 19% per year for the last 5 years. We do see a drop in 2020. Again, that's the year that they acquired UTX. And so a lot of that drop in profitability can be a result of the acquisition and integration costs of that deal. EBITDA, or earnings before interest, taxes, depreciation, and amortization, looks basically the same as gross profit, growing at 21.5% per year, with the same drop in 2020. Now, we have seen a decline in margins from 20 to 25% to more of a steady 20%, slightly under in the high teens. I don't find this very worrisome. The company still has excellent margins, and for being in an industry that requires a lot of research and development, 20% margins is still great. I'm not worried about this slight drop. It can stay at 20 for a long period of time. It has been steady at 20, and I don't see any issue with that. If it starts to drop to like 15 and maybe under 15%, then I would start to worry about the company's margins. Annual operating earnings, again, have been growing fairly steadily. We do see some whipsawing here between 2019 and 2020, but the company has recovered, stabilized, and in the trailing 12 months is nearly over its peak in 2019. The 5-year CAGR has been approximately 26%, which means that this company is still growing very healthily. And for the total shares outstanding, we do see a large jump following the acquisition of UTX, but in general, the company is buying back shares over time. There's a small bit of dilution between 2018 and 2019 when the company RTX did issue shares, but if we look at the long-term trend, they are generally buying back more shares than they issue, which is always great for shareholder profitability. And to take a look at RTX's balance sheet, the annual cash and short-term investments did have a great bump at the time of the acquisition, but it has dropped down to more normal levels. I'm not worried about this drop as long as this drop doesn't prove to be consistent in any sort of way. If the company continues to drop down to, 3 million, 2.5 million in cash and short-term investments, if that continues to drop lower and lower, I might be more worried. But even then, I could see reasons for it. Annual cash levels can fluctuate for a number of reasons. So this is just nice to know that there is a significant amount of cash on the company's balance sheet. RTX's annual long-term debt has dropped by 5.5% per year, which is excellent. I always like seeing long-term debt go down. There are times, especially in 2020 and 2021, where interest rates are incredibly low, and I can understand expanding your debt because it's at such a low interest rate. RTX didn't do this very much. They did a little bit, and they are currently just focusing on, looks like, staying steady at their current level of leverage. We'll see if the company, decides to pay down more debt or increase its debt. But in general, this kind of sloping down and then kind of staying steady for a while is good, in my opinion, to see. I prefer to see it go straight, down, but that's just me. I like less leveraged companies. And speaking of leverage, their interest expenses have also gotten better over time. It has grown by 3% since 2018. But if you account for inflation, is actually under the rate of inflation and is also much lower than their annual return on their investments, as shown by like their revenue growth, EBITDA growth, and profit growth. So I have no issue seeing their interest expenses growing by 3% per year when they have been growing earnings by closer to 15 to 20% per year. Raytheon's levered free cash flow has been quite spotty, but in general, they are a free cash flow positive company. This is typical for the defense industry. Deals, as you saw earlier, come in large chunks. They don't come as, easy transactions that happen once or twice or, 1,000 times per year. So free cash flow can kind of fluctuate a little bit, but we see that in general, the company does make more than it needs, and that money can be turned around and put into acquisitions, research and development, or dividend payments. Raytheon's free cash flow per share has dropped over time, which is a slightly more worrisome trend that could also be further affected by this $3 billion write-down that I discussed earlier. So the company's free cash flow is looking a little bit more suspect due to these costs. It is a trend to watch and to see just how negative or less positive that number can go. It's not something that currently worries me for a long-term situation, but for the short term at least, it is a major headwind. The company will probably be struggling to make free cash flow on top of their expenses due to this production failure. And with some of that free cash flow, RTX does pay a dividend. The chart lies a little bit. Following the acquisition of UTX in 2020, the dividend did change, and that's a result of that acquisition. If you were to just follow based on the shares of RTX, the company has paid a growing dividend over time. I believe close to 3 decades at this point that has paid a growing dividend. So the chart is an absolute number, not relative. So just so you know that, in general, though, the company is paying a slowly increasing dividend, and that's what I like to see. I love to see companies that increase their dividend over time. It just makes my yield grow over time. It helps with returns. It's, there's no complaining about a growing dividend as long as the company is doing it in an intelligent way. And to measure that, we have the payout ratio. So in 2020, we have nothing because the payout ratio is negative. The company was not free cash flow positive, and so you can't have a payout ratio above 0 if you don't have free cash flow. But in general, we see that the company before the acquisition was around 40% payout ratio. That number did jump, but has been coming down. It's currently sitting in the mid 50% to 60%. And that is a number that I would like to see come down a little bit more, but 60% payout ratio is still not bad at all. And now we get to go to the value chart. So this black line represents the closing prices on a weekly basis for RTX, and this purple line represents the fair value of the company at a given PE based on its earnings for that year. So anytime you're above the line, we would assume the company is overvalued. Anytime you're below the line, the company is undervalued. So Based on this purple line, it looks like Raytheon is undervalued currently. Our fair value PE is currently listed at 25.91, and that's because the earnings growth over the last 5 years has been 25.91. For any company that is growing earnings above 15% per year, I believe the fair value of that company should be the same PE as its growth rate. So since the growth rate is 25.91, that is the growth rate that appears here. I can also modify this because I do believe that 26% is probably unrealistic into the future, and that is shown here as at the projected CAGR of almost 10%. So that's what analysts believe the next 5 years will hold for Raytheon. So I might change that to a more normal 15 times PE, and we do see that the company is still quite a bit overvalued on a 15 times PE basis. Or if we change that to maybe 20, we're seeing that it's just coming into that fair value PE. Raytheon, since it is a large and relatively safe company due to its diversity in the defense industry, it does usually command a premium. And I think the 20 PE is a pretty fair premium. I wouldn't call it undervalued, but I would say it's pretty fair valued. And then here at the bottom of the PE over growth ratio is just the current PE divided by its projected growth over the next 5 years. So anything below 1 is fantastic. 2 is also a decent number, especially for such a mature company. So if I'm seeing anything from this chart, it's that Raytheon is probably entering a fair value area, but I don't see any margin of safety here for the company. So just to recap, what I like about Raytheon is that it is tied to the American defense spending. America will always spend money on its military, and Raytheon will be one of the main beneficiaries of that for a very long time into the future. That is due to its cutting-edge technologies. It needs to continue to produce more cutting-edge technologies as required by the United States defense spending. So it will continue to be on the leading edge of several different technologies. And it has reliable long-term historical and future growth. Again, this is tied to America's defense industry. America, let's call a spade, they love weapons and always having the most advanced weapons in the world. So I don't see that funding going anywhere anytime soon. What I don't like is that there is still some uncertainty following their engine expenses because this was a metal that was defective. There is the potential that there's more places that this metal is used or more places that this metal is defective. So we might not know the full extent of the damages beyond the $3 billion. It also does have very high capital and research costs. This is needed in the defense industry in order to stay relevant. Otherwise, you'll be passed by your competitors. So you need to spend a high amount of your earnings on research and development, as well as the capital that is required to build these massive technologies, whether it's missiles or planes or engines or whatever. And then third, I don't like the ESG and morality concerns. You are buying a defense company. These are weapons that are used to harm other people. So I completely understand. There are, myself included, I'm a bit more cautious about investing into things like that. Even though it might be a cash cow, it could make a lot of money. It is difficult to justify putting your money into something that directly goes towards harming others. So that might be a concern for you. It might not be. It's just something that I like to keep in the back of my head. So if I had to say what I plan on doing with Raytheon, I believe I'm probably going to wait a little bit longer. I don't see a beautiful margin of safety. If anything, I might start a small starter position just to watch the company further. And if it never comes back, it just immediately shoots back up, then I have a small and profitable position. Otherwise, with the starter, it's just nice to put it on your radar. You pay attention a lot more closely to stocks that you're invested in, right? So I would say at best, I put a small starter position in right now. Also, it could just end up being that I hold off until there's more price drop and maybe a little bit more clarity on how much the company is going to take a hit to earnings due to these write-downs. So those are my thoughts. I hope you enjoy the video. Please let me know your thoughts on Raytheon, on the industry as a whole. Maybe let me know what you think about the video. If you have any constructive feedback, that would be excellent. But yeah, please leave a like and subscribe if you can, and I'll see you next Wednesday.